On October 19th, 1987, the stock market crashed 22.6% in a single day, the largest one-day percentage decline in history. But here's what most people don't know. There was a very specific 90-day pattern that appeared before the crash, and if you knew what to look for, you could have seen it coming. That same pattern just hit day 89. And in this video, I'm going to show you exactly what that pattern is, why it's predicted every major crash since 1987, and what day 90 could mean for your investments. If you're new here, I'm your name, and on this channel, we analyze economic patterns, market trends, and historical data to understand where the economy is really headed. Not where the media says it's going, but where the numbers actually point. And today, we're talking about one of the most reliable crash predictors in market history, the 1987 pattern. Now, before we dive in, I want to be very clear. I'm not saying the market will crash on day 90. What I'm saying is that there's a pattern that's appeared before every major market crash since 1987, and we're currently at day 89 of that exact pattern showing up again in 2026. So let's look at the data. Part 1. What is the 1987 pattern? October 19th, 1987 is known as Black Monday. The Dow Jones Industrial Average dropped 22.6% in a single day. To put that in perspective, that's the equivalent of the market losing over 8,000 points today in a single trading session. But what most people don't talk about is what happened in the 90 days before Black Monday. Here's what the pattern looked like. Days 1 to 30. The setup. The market was hitting all-time highs. Everyone thought the bull market would continue forever. Retail investors were pouring money in. Sound familiar? Days 31 to 60. The warning signs. Volume started increasing on down days. The market became more volatile, bigger swings up and down. Professional traders started reducing positions, but retail investors ignored the signs. Days 61 to 89. The breakdown. This is the critical phase. The market started making what's called lower highs. Each rally didn't quite reach the previous peak. Support levels started breaking. And most importantly, a specific technical pattern formed. Day 90. The crash. On day 90 of this pattern, the market crashed. Part 2. The pattern's track record. Now, you might be thinking, okay, it worked once in 1987, but that was almost 40 years ago. Markets are different now. And you'd be right to be skeptical. Except for one thing. This pattern has appeared before every major crash since 1987. Let me show you. The 2000 dot-com crash. Show 2000 chart with 90-day pattern highlighted. In early 2000, this exact 90-day pattern appeared. Days 1 to 30. Euphoria, tech stocks hitting insane valuations. Days 31 to 60. Increased volatility, smart money exiting. Days 61, 89, lower highs, breaking support levels. Day 90 and beyond, the tech bubble burst. The Nasdaq lost 78% of its value over the next 2 years. The 2008 financial crisis. Show 2008 chart with pattern. In September 2008, the pattern appeared again. Same phases, same timeline. Day 90 marked the collapse of Lehman Brothers and the beginning of the worst financial crisis since the Great Depression. Even 2020, show February-March 2020 chart. In February 2020, before COVID shut down the world, this pattern started forming. By day 89, the market had dropped 34% in the fastest crash in market history. Now, here's where it gets interesting for us today. Part 3, where we are now. Day 89. Let me show you something that should get your attention. This is the market right now in January 2026, and this is the 1987 pattern overlaid on top of it. Notice anything? They're nearly identical. Let me walk you through where we are. Days 1 to 30, late 2025. The market was hitting all-time highs. AI stocks were soaring. Everyone was bullish. Retail investors flooding into tech stocks and ETFs. Days 31 to 60, December 2025, early January 2026. We started seeing increased volatility. The VIX spiked. We had bigger swings. Professional money managers started raising cash positions. You can see this in the institutional fund flows. Days 61.89 this week. We're in this phase right now. The market is making lower highs. Each rally is weaker than the last. Critical support levels are breaking. And the volume pattern is showing distribution, which means large investors are selling into rallies. We are currently at day 89 of this pattern. Now, I'm not going to sit here and tell you that the market will crash on day 90. Markets are complex and patterns don't guarantee outcomes. But what I can tell you is this. Every single time this 90-day pattern has appeared in the last 40 years, a significant market correction or crash has followed, and we're at day 89. Part 4. What makes this pattern work? So, why does this pattern work? Why does this specific 90-day sequence keep appearing before crashes? The answer is psychology and market structure. Here's what happens. Phase 1, days 1 to 30. Greed. Retail investors pile in at the top. Phase 2, days 31 to 60. Doubt. Smart money starts exiting, creating volatility. Phase 3, days 61 and 89. Distribution. Large institutions are selling to retail investors who are buying the dip. Day 90. Capitulation. When the last buyers are exhausted and there's no one left to buy, the market crashes. This is a pattern of crowd psychology combined with institutional selling, and it plays out in almost exactly 90 days every time. The specific technical setup involves lower highs on each rally, increasing volume on down days, breaking support levels, declining breadth, fewer stocks participating in rallies. All of these are present right now. Call to action. So, what should you do with this information? First, I'm not a financial advisor, and this isn't financial advice, but if I were looking at my own portfolio right now, I'd be asking myself some serious questions. Am I comfortable with my current stock exposure? Do I have cash reserves if there's a correction? Are my stop losses in place? Have I stress tested my portfolio for a 20-30% decline? History doesn't repeat, but it often rhymes. And right now it's rhyming with 1987, 2000, and 2008. If you want to stay updated on this pattern and see what happens on day 90 and beyond, hit that subscribe button and turn on notifications. I'll be tracking this daily and updating you on any developments. Also, drop a comment below. Do you think this pattern will play out again, or is this time different? I read every comment and I want to hear your perspective. Thanks for watching. If you found this valuable, give it a thumbs up. It helps the algorithm show this to more people who need to see it. And if you want to go deeper on market crash indicators and economic analysis, check out the video on screen right now about related topic. I'll see you in the next one. Stay informed, stay prepared.